Let's see. Host is muted. Our mic. We're muted. The host got to unmute us, right? Boom. All right, now we good, right?
We're live? Are we live?
How you doing, Abby?
Hi, Chris. How are you?
Boom. I'm doing really well. Another week, another show.
Another week.
I'm excited. I'm excited.
Okay.
I have. I'm still on the road. So today I'm in Huntsville, Alabama. So I'm hitting all the country spots.
Oh, you in Alabama. So
Yeah.
you left
Yeah.
Mississippi to Alabama. We'll
Boom. And
talk about
then
Alabama another day.
come on, absolutely. You don't ain't gonna worry about it, right? This is but I'm at actually my mentor's house, so he calls it. This is always like God's country. So, uh, uh, yeah, so it's all good. So good deal. So today's we'll have a good show. So let's go ahead and get started. So I'm Christopher Bush.
I'm Abby Joseph.
Hey guys, welcome to another episode of the Red Line. We got some some good stuff for you guys tonight. We're gonna kind of shoot from the hip, right? So we got some good information. So go ahead and play our intro.
That's Hunter. That's Hunter.
Boom, we back. Somebody asked, like, where's my business located? It's located in, I'm in Goshen, Mississippi. So my office is actually on Goshen Van Cleve Road, if you're from Moss Point. But I used to go to First Baptist in Moss Point, Mississippi, Miss Peyton. So yeah, my mom still goes there on Main Street. So I don't know if you go there, but hey, Miss Peyton.
Were you born in Mississippi, Chris?
Yeah. I was born in Pascagoula, Mississippi, at Singing River Hospital. All right. Boom.
Awesome.
Yeah, so that's good. So what we got tonight?
We have a great show for you guys tonight. Tonight we want to actually break down what is a deduction, right? And how does IRS sees how you are deducting your expense. And the reason why I wanted to speak about that tonight is because tax season is almost over, and it is one of the biggest issues that I found throughout the year, and was in every year, is that what our viewers are learning in Instagram, YouTube from influencers, and what IRS says is two different things. So we want to really get you guys to understand, one, what is a deduction? Two, what is considered a necessary and ordinary deduction, right? Expense. And we want to go over, what is the difference between a credit and a debit.
Boom. So you got a full plate tonight. Come on. So since you got a full plate, I don't want to hold you back on your stuff. So let's kind of get right into it then. Let's what you got for it? Where you want to start?
I always want to start with you guys. Let me see. Let me share a screen with you guys. I always love to go to irs.gov. So let's go to irs.gov. Let me see. Let's make sure you guys can see my screen. Let's do this instead. Nope. Let's do this instead. All right. Can you see my screen? Can you guys see my screen? Let me see if I'm. Can you see my screen? Can you hear me, Chris?
Yeah, I can see your screen.
Okay, perfect. Guys, I always love to go to irs.gov with you guys. And the reason why is I want whatever it is that we talk about, I want it to be directly from IRS, right? So what is the difference, right? What is the difference between let's just say a debit and a credit? I know you guys love Google University. Let's go straight to Google University. A credit and a deduction. That's the word. You hear me say credit and debit? And then what we're going to do is I want you to go straight to irs.gov, right? IRS literally says how credits and deduction works. A deduction can reduce the amount of your income before you calculate the tax owed. It's literally what IRS says, right? So how does that work? So when you're looking at your total expense, let's just say my total my total income for the year is 100K. Let's use 100K for an example. And I have a total of $20,000 worth of deduction. Well, that lowers my net income to about 80K, right? Whereas as a credit, IRS says credit can reduce the amount of tax you owe. So the difference is one of them lowers your net income, the other lowers your tax liability. Does that make sense? So let's go back to that 100K. Let's just say I owe, my total income is 100K and I have $20,000 of deduction. That leaves me with a net income of 80,000 deduction, but I have $10,000 of a credit. Well, whatever my total tax liability is subtracted from my total liability. I wish I could draw. So let's go back to that example. If I have 100K, and I want you guys to chin in with if you guys understand or not. So I have 100K, my total net income, my total AGI, which is my gross income. If I have $20,000 worth of deduction, that leaves my total net income as 80,000, right? And depending on where I'm at in the tax bracket, let's just say I owe about $10,000 worth of tax. Well, with a credit, that $10,000, right, would be subtracted from whatever my credit is. So your credit is subtracted from your tax liability, whereas your deduction is subtracted from your total gross income, right?
Okay, I'm sorry. I was going to ask you, like, give me an example of a credit. What would be a credit versus a deduction?
Okay, so let's just say my travel expense is a deduction, right?
Mm-hmm.
A credit would be my Tesla.
Your Tesla would be a credit, not a deduction. Why wouldn't a Tesla be a deduction?
Well, then, because the EV, right, the electronic vehicle is a credit. There's a credit that is being given for purchasing that vehicle.
Correct.
Right?
So, yep. So can we is there a situation where we get a credit and a deduction? So if we're buying a Tesla, we get a credit of 7,500, I think, right? But if if the Tesla is in our business name, we will then get a business deduction.
So it's not well, it depends on, right? And I'm glad you brought that up. It depends on, okay, are we depreciating the vehicle or are we deducting the expense of the vehicle? So when we're deducting the expense of the vehicle, we're deducting either mileage or we're deducting the maintenance of that expense, but or the not the payment, but either the interest or the finance of that vehicle. When we're depreciating a vehicle, we're depreciating either a percentage of that depreciation can go up to like 5 years. So you can do both, right? But it's going to be depending on the percentage. So one of the things that your accountant will ask, Chris, is what is the percentage of you using that vehicle for business? So what I find that influencers will say is that, listen, you can use the I-70, the 79, the bonus depreciation.
Section 179 of the code.
Correct.
But that's only if you purchase it, right? But it's not if you lease it. Leasing that doesn't count as a Section 179.
No, it doesn't. Right? You cannot depreciate. You cannot depreciate a leasing vehicle. You can deduct the finance, meaning whatever the amount that you pay per month on that vehicle or the interest you paid on that vehicle, but you can't depreciate a leasing vehicle, if that makes any sense. So again, remember the credit, right, is in a specific amount. right? It's a specific amount that IRS or the government will throw out there. Like we can use some example of credits. We can use, like, say for an example, my tuition expense can be a credit, right? Adopting a child, you can obtain a credit. Solar, using the solar system, right? That can be a credit. A deduction, guys, need to be both ordinary and necessary. So you may say, okay, Abby, what does ordinary and necessary means? Ordinary literally means that that deduction is specifically for the purpose of the business. Like, say for an example, for me, right? In order for me to run my business, I need to have QuickBooks. That's ordinary. I need to have that, right? And necessary is pretty much the purpose of the business expense deduction usually means it's helpful or opposed or required. So what happened is that there was one of my client reach out to me this week and say, hey, an influencer says that I can actually deduct my birthday party. And I said, your birthday party. So how do we explain to IRS that birthday party, right? Let's just say my 40th birthday party, I throw a party, there's 50 of us. How do I explain to IRS that this was business related? So the person individually said, okay, we can make this birthday party a masterclass. Then call it a masterclass. Don't call it a birthday party, right? Because then in IRS mindset, we are manipulating, right? We are manipulating the law. And that's one thing you don't want to do. Then we are functioning unethically.
Gotcha.
Right? So you want to make sure your expenses are ordinary and that they are necessary. You want to also make sure that your expenses are aligned with your business. It's kind of like saying you are a financial advisor, Chris, right? But you went, let me see, what did you purchase? What did you purchase? Oh, give me an example. What you went and purchased, okay, you like to play golf. You went and purchased a golf cart, right? And you said, well, that was for business. And I use it as a business because I meet with my client every day. I meet with my client in this golf cart, right? And we play golf. You're going to have to explain, you're going to have to show proof to IRS that you will never use this personally.
Other than me going to play golf.
Other than you playing golf with what? With your business partners.
Yeah, or clients.
Or clients. Same thing as.
So even if what if I just put my logo on there? That doesn't make it a business?
Well, if you put your logo in there, now it has an identification. It has an identity. Things have to have an identity, right? It's the same thing that, I'll find influencers that say, well, Abby, I bought these bags for $5,000 and I want to be able to deduct this bag. I use it, the way that I look is very important. I use it. Fine, you can deduct it, but you're going to have to show proof to IRS that you will never use it personally.
Yeah.
So I think there's a fine line, and we need to kind of like think about, it's really easy. You need to ask yourself this question. Is this for me or is this the business?
Yeah.
If you can answer that question, then you're functioning ethically. But if you try to manipulate, because my issue is not necessarily that you are desiring to deduct as much as you can, is the manipulation.
Yeah.
It's a red flag when you're trying to manipulate IRS.
Yeah, and manipulation is key, especially when there's no documentation, right? So the thing about it, so if you can say that I'm not manipulating the IRS or the code, it's that documentation that you do with it, right? And I think that's one thing we don't talk about enough. Even as I got started into the business in the beginning, right? That documentation, because you're so focused on, for me, gaining clientele, building portfolios, make sure the investments are going well, right? Doing all the things for the client, right? So the second thing is, okay, but I got to run a business. I'm not just an advisor, right? That's what I do, but I run a business as well, right? And those are two separate things. You can be a great artist, but are you great at the business side of artistry, right? So that's the part that's huge, and where you want to have help, and I'm helping your corner to facilitate that.
Yeah. So some of the things that are qualified as business income deductions, guys, one of the big things I tell people is like IRS is public. Just like when you are in the stock market, right? And you are reviewing a ticker. Let's just say you're reviewing Apple, for an example, right? You need to know the fundamental side of Apple, and you need to know the technical side of Apple. So whenever anyone goes out there, right, and providing you these information, it is important that you do your DDs. You can go to irs.gov. You can review it. You can Google it, and then go straight and verify it. It's just, I think when terms are important, there's a definition for every word we use, right? So when we say birthday party, what is in our mindset? Personal.
Yeah.
This is a personal event. It is not a business event. Yeah. When we say masterclass, when we say webinar, when we say conference, now if you want to turn your birthday to a conference and you want to deduct that as a business expense, I'm all for it. Do not call it a birthday party. Don't call it a birthday party. Yeah. So now we did have a couple of questions. One of the questions that someone did have was the one you always provide. It's a question regarding HSA. Miss Emily, what's the HSA question? I know you did have that last week, you said.
Yeah. So I think she was referring to, I don't know if it was a kind of a question in the email, but what I read from it, she was just asking, is it a good idea for her to trade out of her HSA? Right?
Is it a good idea to trade in it or out of it?
Well, inside of it, right? I believe she's doing some type of day trading, I believe, right? Emily, if you're there, you can help us out.
You can. I don't know if you should. You can trade inside of your HSA. The only thing is your HSA, there's only a specific amount that you can actually roll over for the following year. So you want to make sure that you stay in line with that specific amount. But you can trade inside your HSA.
Yeah. When you're having any account, any account you can trade out of, I think it really boils down to, like we kind of talked about on previous shows, is how good are you at trading, right? If you're not that great at trading, then maybe you probably shouldn't be trading it, right? So I think it's as simple as that, right? If not, you want to say, hey, look, I'm picking great positions, whether it's ETFs, whether it's individual stocks or combination, mutual funds, however you're doing it, and hey, I'm letting that ride, right? But I think it's really about your strategy. And I think even with some of my clients, personally, if we want to have a more of a active role inside of an HSA, then we can do that. But okay, let that be managed professionally, or we can kind of pick some things out. But it's totally up to you on how you do it, right? It depends on what your skill level is at trading. That's all I tell people, right? Any account, trade it, but what's your skill level? Okay.
Yeah. So most likely, I think Emily is a day trader. So she probably know what she's doing.
Well, it looks like she's a real estate agent as well, So
let's go, Emily.
Right. Emily, I don't know where she's located. So if y'all
know. Emily, I think Chris asked where you located.
Right. She was talking earlier, but it's okay. What other question did you have on yours?
List some deductions that they can deduct. So we can go over some of these deductions. Okay. Yeah. We can list them. So when it comes to that's necessary. Let's go over some necessary deductions. So okay, so like as personally, your daycare expenses are considered a necessary expense, right? Well, no, let's move out of personal. Let's go to the business aspect. So when it comes to your business, right? You have, if you look, you have your advertising, that is an expense. You have your vehicle expense. You have professional expense. You have supplies expense. You have travel expense. You have meal expense. Entertainment is not a deduction.
Yeah. So what would that be?
Entertainment is not a deduction at all. You can't deduct entertainment.
Gotcha.
And this is why too, when my client says my birthday party can be a deduction, to me that's entertainment, right? You're entertaining individuals, so entertainment is not a deduction. What else is a deductions? Continue education. If you are a trader, you already know your subscriptions, your trading view is a deduction. Continue education, any books you purchase that is related to the business, any conferences that you attended, any seminars. Those
let me ask you this. So I know when I was an employee, because there's a lot of people that may be employees, maybe don't have a business. So like I would go to a lot of conferences, seminars, books, I would do those things to personal develop as a W-2 employee. How does that help me at all?
Okay, so understand that tax benefits is not created for individuals. Tax benefits are created for business owners. So you can't deduct those.
Absolutely.
Unfortunately. So your business expenses, guys, you can't deduct. So here's what you can do on a personal level. You can deduct. So let's just say I have my home office, right? This is my office. So what I can do is let's just say my house is let's say my house is 3,000 square feet and my office is about 300 square feet, right? Let's take this calculator out. If my house is 300 square feet, I'm going to take 3,000, right? We're going to divide it by 300. That gives me about 10%, right? Yeah. I can actually deduct 10% off my mortgage, my interest, my tax, my maintenance, my light bill, my water bill, all of my expenses, my phone. So I can actually deduct 10% off of all of those expenses. So then you will find people will say, oh, you can deduct everything. I think maybe that's what they mean when they say you can deduct everything. So it's not everything you can deduct. You can deduct a percentage, and that is based on your square footage of your office.
Absolutely. We got a question. I paid $5,000 for the trade and travel course. How can I deduct it? Again, if she's not a business, then that can't be conducted, right? If she doesn't have.
If you are trading under an entity, a solo to music, if you are trading under entity, yes, you can deduct that expense. That expense would be educational expense.
If it's paid under business name, then of course, yeah. If it's paid under business name, right, it's huge. And I guess I want to talk about that just a little bit as well. Maybe we have, but I think it's so important to build wealth. Find a way to have some type of part-time business that's legit, right? Because it not only just helps you for your mental, but it helps you from a tax perspective. It helps you build wealth quicker. It helps you get to where you want to go. And I know there's some people that say, hey, Chris, I don't want to be an employee. I don't want to be, in business. I don't want to have a part-time business. And again, it's okay, right? But just understand, if you want to be able to maximize your income coming in, having something that you're doing part-time that you can turn your passion into profit. It's so important to be able to focus on that, because that's what I find out a lot when I'm doing financial plans for clients. The biggest thing is, if you don't have the income that you need, then we got to focus on how can we increase that income, right? How can we do something part-time? How can we turn something into a business? Because those are times where you can really start to move forward and kind of pick up that pace.
Oh yeah, and not only that, I mean, who does not want passive income?
Right.
It's literally, so there's 3 types of incomes, right? We have earned income, we have passive income, and we have portfolio income, right? Earned income is our W-2. Passive income is what we can obtain from
hiring others,
from real estate, and portfolio income is the stock market, right? Our dividends. So when we're looking at those 3 incomes, me personally, I feel like all of us should at least be active in all those 3 incomes.
Absolutely.
Right? Yeah. So maybe we start off with earned income. Maybe I started off with a W-2, and now I use that income from my W-2 to build a passive income. Yeah. And then the passive income have created a portfolio income.
Absolutely.
That makes sense.
Yeah.
So I think all three of us should, I think those three incomes should be something that as a whole you look into. One income, if one income is content, if you content with one income and you make enough to serve you well, then that's fine. But if you're looking at other ways to invest and build other income, then passive income and portfolio income is an amazing way of building wealth. Is it paid under a business name? So let's just say, Leo, let me see. Let's take that question. Okay, so the question Leo asked, is it paid under a business name? So if it is paid on a business name, then yes, you can deduct it. If it's not paid in a business name and it was for business purposes, then you can have your accountant provide you what's called with an accountable plan. And with an accountable plan is when we use our personal money, right, for business purposes, and now we need to be reimbursed for that. So if you use your personal funds to actually for that course, and you are trading under an entity, then request an accountable plan from your accountant. Can you deduct online trading courses? J. Altimore, if you are trading under an entity, yes. Remember, I said if you are trading under entity or TTS status. TTS status is trader tax status. So if you are trading under an LLC, S Corp, or C Corp, yes, you can. Okay. Is it too late to change your trading personal to business? I trade daily. So Char, there's going to be some specific questions that I would want to ask you to make sure that one, you are a day trader, two, that you are a profitable trader, because then we are in March, right? Being that we are in March, we're still early in the year. So yes, you can actually start trading under an entity if you meet those requirements. Remember, we spoke about what those requirements are, right? Let's go to, let me see, am I sharing screen still? Let me share screen with y'all. Okay, perfect. Thank you. So let's go to ios.gov. Remember we talked about publication 429, not 475. So you want to make sure that you've met these requirements. If you met these requirements and you are and you want to actually start trading under entity, then yes, you can, right? Then you want to create your entity. Now, write this down. Once you create your entity under federal, state, and county level, right? The state level is ios.gov. The federal level is ios.gov. The state level is depending on what state you're in, and your county level. So once you register your entity, you created your entity, you want to open what's a business checking account. Once you open that business checking account, you want to fund the business checking account. Once you fund the business checking account, then you want to go to your brokerage, right? You want to go to your broker and you want to open a business brokerage account. Once you open your business brokerage account, then you want to fund the business brokerage account, but you want to fund it from your business checking account and not your personal account. And then you can start trading under a business that are trading under your social security number. Leo Funkhauser.
Sorry, I'm back.
No, you're perfectly fine. I've been sitting here just answering questions. So I hope that answered the question for you. No, I think it was Char. That was your question. Is it too late to change your trading from personal to business? If you meet those requirements, no, it's not. TTS, thank you for ios.gov. No problem at all. So yes, do read the publication 429. The publication 429 does go over what those requirements are. And if you are eligible, then absolutely. Perfect. Absolutely. All right. So we talked about those different deductions, guys. Remember, on a tax benefit was never created. It was at one point created for personal and business, but our wonderful past president had changed that. So, and the reason why he changed that is because he increased the standard deduction. If you remember 10 years ago, the standard deduction was not so high. So what he did was he said, hey, listen, I'm going to take away these personal deductions that you can deduct. Remember, you used to be able to deduct moving expense. You used to be able to deduct improvement that you've done in your home. Those deductions have went away. So what was his name again? Donald Trump. So what Donald Trump did was he said, hey, listen, I'm going to take away those deduction and I'm going to increase your standard deduction. So because the standard deduction on a personal level increased, now he made it to where the benefits are all for business owners, not necessarily personal. So on a personal level, what it is that you can deduct, you can choose two things. You can use the standard deduction, or you can use itemize. You can itemize your deductions. And pretty much what itemizing your deduction does is if your personal expense outdo your standard deduction, then you should itemize. But if they don't, then the standard deduction is the best for you guys.
Well,
that was a mouthful.
Look at you. All right. So I know I had a question that I was going to really tap into tonight. One of the questions that I received was from, let me see I forgot who was from already.
Well, you can't say the name.
Who was it from?
Well, you can't say the name.
Oh, I can't say who. Okay. So I can't say who it's from. Okay. Someone emailed, we talked about, hey, thank you so much for what you do. Please, could you explain the self-directed Roth IRA and how to set that up? So I think that's an interesting topic. When it comes looking at self-directed IRAs, whether that's a self-directed Roth, that's a self-directed traditional IRA, those cannot typically be done, let's say at a TD Ameritrade or Charles Schwab or a Fidelity. You got to make sure you have a trustee attached. So companies like the Entrust Group or Equity Trust, there's a couple of them. If you Google, there's like quite a few. I've used Equity Trust. I've used the Entrust Group for mine before on transactions. So what a self-directed IRA is, how it works differently than a Roth or a regular traditional, is just the asset class. Okay. Traditionally, if you open up a traditional Roth IRA or a Roth IRA or traditional IRA, you're only going to be able to do stocks, bonds, mutual funds, those type things, right? So with the self-directed, now you're really self-directed that money into whatever asset class that you want to have. So that's allow you to get more diversification. Okay. So for instance, I'm actually working with a client right now that he's retiring, but he's still working, right? So he retired, he's going to have a decent sized pension, he's going to have a lump sum, but he loves to hunt. Okay. So one of his favorite things is that, so since he loves to hunt, he wants to actually use a portion of his lump sum that he's getting from his job, from his pension. He really wants to use that money to actually purchase land, right? So he can actually then hunt, he can lease it out. He can focus, he's looking at the mineral rights. We're looking also at the timber that he can sell from that land, right? So he can actually buy that land inside that IRA, okay? So we can roll, again, it's typically done when people have a lump sum of money or money coming from a previous job or a lump sum that's, pre-tax money that you can kind of put in there, or after-tax money if it's a Roth. But remember, the contribution limits are still the same, right? So you still can't contribute more than that $6,500 a year if you're under the age of 50 years old. If you're over the age of 50, you can do $7,500. The monthly contributions are still the same. The yearly contributions are still the same, right? But it's about what you're able to roll over inside that IRA. Okay. So in this case, he's getting close to like $192,000. So, of that, he said, well, Chris, maybe I want to use $50,000 of that to invest inside of a self-directed so I can buy this piece of land. But just remember, when you're buying assets, right, inside of an IRA or a traditional IRA or a Roth self-directed, again, those profits have to go back to the IRA, right? So let's say you invest in real estate. Okay, say, hey, look, I want to buy this property for $100,000. I use my traditional or Roth IRA. I'm self-directed. I have inside. Well, if you're getting rental income from that IRA, that rental income is technically profits, just as it would grow inside of a stocks, bond, mutual fund, or ETF. So those profits have to go back to where? That account.
Okay.
Right? You can't just say, oh, since I invested in real estate, I can pull those profits out and put that money into my bank account. Right?
Even if it's a Roth?
Correct. Yeah, because I'm going to take that back. right? So inside of a Roth, there's ways that you probably can and not be penalized, unlike with the traditional IRA, right? Because
Yeah.
again, in a Roth, you can pull money out,
Yeah.
right? So you can hold it for the first 5 years. So yes, you can actually pull money out of the Roth side. And you can still do it from a traditional side, but understanding the tax implications, they don't go away. That's the whole point. The tax implication of that do not go away inside of a traditional or Roth, right? So if you say, hey, look, I'm putting the money in and taking right back out, Roth, you're going to get that 10% early withdrawal if you're not 59 and a half. And if you have not held an account, at least been open for at least 5 years, right? So I think when it comes to your inside of your financial plan, I guess the question is, well, when do I start to incorporate a self-directed Roth or a self-directed traditional IRA? It's really going to depend upon, again, your entire financial plan, right? Because I don't want somebody to get stuck into invested into a traditional Roth self-directed, and they may need to start getting income from that account, but maybe the real estate has not been developed, or they bought land and they can't sell it, right? So it's not, it tends to be less liquid sometimes, depending on an asset class, but it gives you also more diversification, right? Other than just stocks, bonds, mutual funds, ETFs, right? So again, it's definitely a great way if somebody's in a real estate game or land, if you want to buy precious metals, that's a way that you can do crypto inside of a self-directed IRA. There's multiple different ways that you can use that self-directed option. Okay.
Actually, we have a client that he had a lump sum in a 401k and didn't know that he had. I love telling this story because I loved how we helped him. And what we did was we converted the 401k to a Roth, and he was trading under the Roth. He was trading cryptocurrency under the Roth. So what he did was we created an entity for him. We created an LLC. The LLC owned the Roth, right? And then he traded under the LLC and the Roth. It was nice.
There it is.
And then that all the gains was
tax free.
And not only tax free, but it was protected as well too, because when that LLC, protected his personal assets.
Perfect. Again, guys, there's so many different ways that we can do that. So, right. So I really think that, self-directed IRA, they have their place. And again, it's really dependent upon your overall financial needs. I just wouldn't just say, hey, look, I got $6,000. I'm gonna put money into a self-directed, because there's also going to be higher fees typically from self-directed options, options of IRAs, because you got to pay a trustee, right? So it's going to be typically high, because again, if you're doing self-directed, now there's more paperwork, there's more documentation, there's more involved than just doing paper assets. So people have to just be careful on, hey, I got to work with a credible company that is good with the documentation of this asset that I'm putting inside this self-directed Roth or traditional, to make sure that I'm hitting all the levers and I don't get caught from a tax perspective from Uncle Sam and all that good stuff. Right?
What would be a decent amount?
So I would say that's really kind of hard to say a decent amount, but at least to cover whatever asset that you're getting, right? Okay. So maybe $25,000, $50,000, right? $100,000. It needs to be a decent amount there, right? There's not, if you're trying to buy gold, 1 ounce of gold for, I don't know, what the price of gold is right now, $1,400, $1,700, right? Okay, I'm going to put 11, I don't think it's worth it, right? You might as well just kind of buy the gold ETF, or, you know what I'm saying? So I feel like it needs to be for a decent sum on an account. How can you transfer your 401k to a Roth when you can only deposit about $6,000 a year? Just curious. So remember, there's only when it comes to retirement accounts, Roth or IRAs, you only can contribute $6,500 a year, but you can roll over $1 billion into a Roth, right? So there's no limit of how much you can roll into an account. It's just in a single year into an IRA, you can't contribute that money. So a rollover is not the same as a contribution. Yeah. Okay. So
so you have contribution, distribution, rollovers, but he had a good $250,000 sitting in his 401k. So what now, was he taxed when he did the conversion? Yes, he was. But that was the last time that he was taxed on it. So taking that $250 and trading crypto, he made a good lump sum from it. And now it's sitting on his Roth.
Yeah, and I also think people have to understand too, of when and how to do a conversion. Okay. So if somebody has a sizable 401k, for me personally, depending upon how savvy the person is, because I want to make sure that, again, they're talking to their tax people, right? Their CPAs, their tax strategists. However, because I don't want to say, hey, look, you got $250,000 into a 401k. Let's automatically put this into a Roth. Well, they're going to owe a bunch of taxes on that daggum thing.
A lot.
Right? You're going to have to pay the 10% early withdrawal. You're going to have to pay the, right? You're going to have to pay the tax. Like you won't have to pay the early withdrawal penalty. Scratch that. No 10% early withdrawal. But you will have to pay, right, your state, federal income taxes, because that's all pre-tax money.
Yeah.
Okay. So there's ways that you can do conversions of your 401k or traditional IRAs to where you're converting it up to that next tax bracket, right? So that way you're not taxed more on that new money. So there's a couple of ways that I use different programs to really look at somebody's full financial plan to say, okay, should they do a Roth conversion? When should they do a Roth conversion? And in your case, they understood the strategy that you guys put in.
Timing is everything. Timing is everything, right? So when your accountant or your tax strategist is doing tax planning, which we will speak in the future, probably in the next month or two, when your tax strategist or your accountant is doing tax planning, one of the things that he or she's going to look at is projection, right? Yeah. They're going to project to see what your end year looks like. And if they can project, say, like we're looking at a low tax liability, right? That means we have a high net income. A low tax liability. If you have a high tax liability, then we're going to talk about, okay, what was the goal this year? If the goal this year was for you to convert your 401k and you have a low tax liability, we're going to say, hey, let's wait till next year, right? Let's wait till you have a high tax liability, then let's convert, because that's going to be income. IRS going to tax you on that as income, right? So we're going to say, let's wait for you to do this conversion. So timing is everything when it comes to taxation. When you plan, it's going to, that's why too, a lot of people, they'll come to me in December and January, and it breaks my heart because it's only so much that I can do. It's really small. What I can do in December and January is very small. But if you come in to me in January, but it is for the current year, then there's a lot we can do, because then by June, July, we're planning, we're projecting, right? And if we can, planning is everything, guys. Tax planning is more important than taxation, than actually completing your tax return.
Yeah. And it's like we just said, I guess, on a previous show, I think this was your first show, that tax planning really comes into play when it's a business versus just a W-2 employee, right? So it's really different. So it says, hey, is there a certain amount you should have for this conversion? I mean, it's dependent upon, so when you're doing a conversion, right, a Roth conversion, it's going to be dictated by your overall income and what current tax bracket you're at, right? So if you're at a 24% tax bracket, right, because if you're on a 24% tax bracket, but we do a Roth conversion, I don't want to put you into the next tax bracket. That would be 28, 32%, right?
Yeah, we don't want to do that.
So I want to stay at that 24%. So I want to convert only as much that's gonna not put you into the next bracket to get you tax anything more, right? So that's all dictated by your personal income, your personal situation. So there's not like a flat number. It's really based on what you have, what your taxes say. So for me as an advisor, when I'm doing conversions, it's not just about my decision. It's also, I need to make sure that me and your CPA or your tax strategist, we need to be in cahoots. We need to understand, hey, if I do this for this client, what is their effect? Correct. Right. So that's why like building wealth is really a team sport, right? To where you should have multiple professionals come together to make sure you're making those right decisions. It's not just saying, hey, look, I'm listening to this one person. They said do this. It don't work like that, right? It should not work that way. Right? It doesn't work like that. Team, I always say, hey, we always say, hey, talk to your advisor. I'm always like, okay, talk to your accountant, right? Talk to your CPA. And then let's us get on a conference call together to make sure that happens. Right.
And what Chris is saying is so important, because you guys, you have no idea how many times I will tell my client, okay, give me a couple of days. Let me speak to one of my colleagues that is a financial advisor and see how this will work. Or you have no idea how many times I'll get a phone call and one of my colleagues that are financial advisors be like, hey, Abby, this is the situation with my client. How will this affect their taxes? Remember, guys, I always tell you, there's 3 people that you guys need to have. If you're building generational wealth, you need a business attorney or you need an attorney. You need a financial advisor, and you need an accountant that understands the industry you're in and that understand how to strategize your situation. So it is not a one-person game. Your financial advisor may say, "Hey, let's roll over this $50,000 you have," and then from your traditional IRA to your Roth, and then end of the year you go to your tax accountant, and your tax accountant said, "This is how much you owe," and you're like, "Why do I owe this much?" Well, that's because you did your rollover, right? That's because, and now because it was not some type of planning, some type of communication between your financial advisor and your account. This is why we made this show like this. This is why we have a tax strategist and a financial advisor.
Yeah.
Because both of them are so important in order for you to be able to build generational wealth.
Yeah. So let's look at this another. Well, Emily, just asked another question real quick. She said, is a rollover different than conversion? Yes. A rollover just means, hey, look, if you have money from a 401k, you're rolling it over to an IRA, right? Or if you say you have a Roth 401k, you're rolling it over to a Roth IRA. That would be considered a rollover. A transfer would be considered, hey, I'm transferring from one IRA to another IRA. That's a transfer. It's not coming from an employer-sponsored plan, right? A conversion is, hey, I'm going from traditional IRA and I'm converting it because the taxes are different. I'm converting it to a Roth, right? Traditional IRAs are typically tax deferred. Roth IRAs they grow tax free. So most of the time, you're going to have an IRA when you have more pre-tax money inside that account. So if I take pre-tax money from my traditional IRA and I'm converting it to a Roth IRA, I'm paying the taxes, right, on whatever's in this traditional, and I'm converting it or making a conversion to the Roth. So those things are different. Okay. When you're going from a pre-tax account to an active tax account, that would be considered a conversion. I guess that would have been an easier way to say it. Made it sound more complicated than it is.
No, you didn't. You didn't make it complicated. Is a past employer annuity taxable? Fed and New York State under 62 and still working.
I guess I don't understand it.
I'm going to have to pull this one up for you.
Well, I think more information needs to go into the question because a past employer annuity taxable. Well, if you anytime you have, let's say, is it a TSA, a tax, right? Is it what type is? So if it's anytime you have a retirement plan, no matter what type of retirement plan that you have from a past employer, right?
Yeah, it's taxable.
Right. Yeah. If it's using pre-tax money, you're going to be taxed. So it's not 50. It's not under 52. It's 59 and a half. So at 59, if you're over 59 and a half, you don't get the 10% early withdrawal penalty. However, if it's using pre-tax money, anytime that growth you pull money out, you will have to pay state and federal taxes.
Mm-hmm. Yeah, you will. You will.
Right? So it's not, it's 59 and a half. You don't do the early withdrawal penalty. After 59 and a half, if it's pre-tax money on the growth and the balance, right, you're going to have to pay state and federal taxes on the money.
Mm-hmm. Yeah. If you want more information, I would say go to irs.gov and pull up topics for number 410. It will literally go over in detail for you. So, but yes, to answer the question, Chris just answered it, but yes, you would be taxed on the federal and the state level.
Yeah.
Let's see more.
Boom. Any other questions we got? We're taking some live questions today, I guess. Anybody have anything else?
Let me stop.
Nothing else, I guess. Let's see.
All right. Today was good. We answered a lot of questions in here.
Yeah. And that's why we really want to give people a chance to ask a question. That's one thing that's huge. So so if we don't have any additional questions tonight, we got a pretty big show that's going to be next Wednesday. That'll be exciting. I'm going to have a full presentation for next Wednesday, kind of go over some higher level advanced planning activities. So I'm kind of excited about that. And then since we're entering the new month,
tax planning, you want to do tax planning?
No, I don't. I'm not going to do tax planning. You doing tax planning? I'm not going to do tax planning.
Yeah. See, I'm trying to get Chris to do my job, y'all.
Come on.
We're trying to get
have me in trouble, right? So so next week will be pretty good. I'll do a full presentation. Going over advanced planning, what that looks like from an investment standpoint. We're going to touch on in April. I want to do portfolio allocation. I want to I really want to get my partner in with me so we can kind of have a couple questions.
We have a guest.
on infinite banking. You said what?
Oh, also, guys, if there's like a specific guest that you guys would like for us to bring in to the show, email us. Let us know.
Yeah.
Chris knows everybody, y'all.
Come on, we can get them on. So, and if you guys have questions, don't forget to send us an email, right? So can we put the email on the screen for us? Can you put the email on us?
He's like, what email?
You need an email? All right, it's there it is.
There it is.
Awesome.
Oh, well, Chris, great show tonight. Okay, guys,
Yes,
thank you
ma'am.
for coming in, showing up, and showing out, and coming with all your questions. That's the goal. The goal is to make sure that you guys are educated on your financial needs and your taxation needs. Thank you for not being so shy in answering and asking those great questions.
Absolutely. All right, boom. So I'll see you guys soon.
I'll see you guys. I'm Abby Joseph, the tax strategist.
I'm Christopher Bush, financial advisor.
And thank you for joining us in the Red Line. I'll see you guys next week.
Take care.